Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. 14%. That's what United Airlines put up this week, leading the entire aviation sector. And it didn't happen in a vacuum.
No, it didn't. The major carriers are having a moment, and we need to talk about why, because the macro backdrop has never been more complicated. IATA cut the global airline profit forecast in half. Fuel is the story of 2026. And yet, the stocks are screaming higher.
So today we're going to walk through what's actually driving that divergence, what the FedEx filings are telling us about balance sheet strategy in a high-cost environment, and whether the eVTOL names are sending a signal or just giving back last month's gains.
And we've got a lot of ground to cover on Boeing. The fourth production line, the NGAD win, Farnborough right around the corner. Let's get into it.
This week's narrative was a stress test separating carriers with scale and balance sheet depth from those who can't absorb the fuel shock. And the market priced that gap aggressively. Not the fuel crisis itself, the market's response to who survives it.
That's exactly right. And what's striking is that this is playing out in real time. Spirit's gone, Magna Carta's gone, Zenith suspended. The bottom of the market is clearing out, and the capacity and slot inventory is flowing upward to the majors.
Operationally, what this means for airlines is that the cost structure has become existential. Jet fuel is now running at roughly 31% of operating expenses industry-wide, up from 25% last year. That's not a headwind, that's a restructuring event.
And for investors, the signal is that scale and network density are being repriced as survival traits, not just competitive advantages. The market is paying up for carriers that can absorb a 31% fuel cost burden and still guide confidently.
Which is exactly what the price action this week confirmed. Let's go to the primary signal.
The most important signal this week came from the major airlines themselves, specifically the speed and magnitude of the re-rating in the legacy carrier group. United up nearly 15%, American up 11%, Alaska up over 10%, Delta up nearly 8%. That's not rotation, that's a repricing event.
Operationally, what that move says is the market believes the majors have sufficient network pricing power and fuel hedging capacity to protect margins, even as IATA forecasts global airline profits collapsing from $45 billion to $23 billion this year.
For investors, the implication is stark. The market isn't buying the sector, it's buying specific survivors. And the spread between the major carrier group and the ultra-low-cost names tells you exactly how narrow the winner's circle has gotten.
That's the thesis that runs through everything we're looking at this week. Now let's look at the actual numbers.
All right, so let's set the table on travel demand first, because it matters for context. TSA screened 14 million passengers this week, up 1.5% year over year, and 2.2% above the 3-year average.
That's an important data point. Demand isn't collapsing. Consumers are still flying. The crisis is entirely on the cost side, not the revenue side, which is actually what gives the majors pricing power to pass through fuel costs.
Right. If demand were cracking, this would be a different conversation. Okay, so let's go through the movers. United up almost 15%. That's your top gainer for the week. American up 11, Alaska up 10.5, JetBlue up 9.25, Delta up nearly 8, Southwest up almost 7.
The common pressure behind this coordinated move was the market's reassessment of survival probability at the top of the market, following the Spirit liquidation and the IATA profit warning. It's not that these carriers suddenly became more profitable, it's that the field got smaller.
That's a great way to frame it. Now on the other side, Kratos down nearly 8%. That's your biggest defense loser. Howmet down 4%. Hexcel down about 2.5%. Boeing down 1.5%.
And then you've got the eVTOL names, Joby and Archer, both off about 10.5% each. We'll come back to those.
Let's dig into the 3 names that matter most this week. United is the poster child for what the market is buying right now. Up nearly 15% on no single catalyst we can point to in this week's filings. But that's almost the point.
The market is re-rating the whole survivor group. You don't need a specific United catalyst when the macro backdrop is eliminating the weak hands and you're the strongest balance sheet in the room.
And then you've got Allegiant up nearly 14%, which is interesting because Allegiant is a low-cost carrier, not a major.
Allegiant held its annual meeting this week, and the shareholder vote results are worth noting. All 11 board nominees passed with between 95 and almost 100% support. Executive compensation approved decisively. There's no governance friction here. Management alignment is clean.
So the market sees Allegiant differently from the ultra low-cost names that are blowing up.
Allegiant has a different model. Leisure-focused, secondary markets, minimal connecting traffic. They're not competing head-to-head with Spirit on the same routes. The risk profile is different, even if the low-cost label is the same.
Fair. And then FedEx, down 3% on the week after that earnings report.
FedEx is the name I want to spend real time on in the next segment, because there's a lot happening there beyond just the stock move. What matters here in the price action is that the cargo complex is bifurcating. UPS held relatively flat, up less than 1%. FedEx down 3%. Same macro environment, different execution reads from the market.
And that's not a small divergence when you're talking about two companies that are supposed to trade in tandem on freight volume.
What matters is that the price action this week isn't really about individual company execution. It's about the market constructing a tiered hierarchy of aviation and aerospace businesses ranked by their ability to withstand a sustained fuel and cost shock. The stocks at the top of this week's leaderboard, the major carriers, are there because investors believe they have the network scale, the pricing power, and the balance sheet depth to be standing at the end of this cycle.
And the names at the bottom, eVTOL, some of the suppliers, are there because when capital gets defensive, the long-duration pre-revenue stories get trimmed first.
Exactly. GE Aerospace up nearly 4%. RTX up 3.5%. HEICO up over 4%. The engine makers and aftermarket suppliers are holding up well. And that makes sense. Aircraft aren't going to be delivered faster just because fuel costs are high, and every plane that's flying needs maintenance.
Lockheed up almost 3%. L3Harris up just under 2%. The defense primes are steady, which also makes sense given the macro backdrop with the Middle East, conflict driving defense spending.
The one outlier I want to flag before we move on is Boeing, down 1.5% despite winning the NGA's 6th-generation fighter contract and having real positive news on the commercial side. That's a complicated story, and we'll come back to it.
Yeah, the market's relationship with Boeing right now it's nuanced. Good news doesn't move it the way you'd expect, and that tells you something about the sentiment overhang.
Let's hold that thread. We've got a lot more to unpack on the filing side. Okay, so FedEx, because this is a company that filed 3 separate SEC documents in 1 week, and when you stack them on top of each other, they're telling a very specific story about how a capital-intensive logistics business is repositioning itself in a high-rate, high-cost environment.
Walk me through the sequence, because the order matters here.
It does. Monday, June 23rd, FedEx drops an 8K with their fiscal fourth quarter and full year results for the period ending May 31st. The stock closes down 3.5% to $317 on the day of filing. No press release content in the excerpt, but you don't need it. A 3.5% drawdown on earnings day is the market telling you the print missed expectations or the guide disappointed, full stop.
And that's on top of a stock that was already under pressure coming into the week. They opened around 328 and closed the week at 318, so down about 3% overall.
Right, but then 2 days later, Thursday, June 25th, FedEx files a second 8K, and this one is the one that changes the narrative. They announce a tender offer to repurchase up to $4.15 billion in aggregate principal of outstanding senior notes.
$4.15 billion. That is not a rounding error.
Not even close. And the structure of this offer is worth unpacking because it's not just a simple buyback. They're targeting 19 separate note series, coupon rates ranging from 2.4% all the way up to 5.25%, with maturity spanning from 2028 out to 2050. The The early tender deadline is July 9th, settlement expected July 14th.
So they're going after both short dated and long dated paper simultaneously. What's the read on that?
The read is that FedEx is being surgical. When you target the full maturity spectrum, you're not just trying to reduce the near term debt service burden, you're restructuring the liability profile to match what you think the business will look like over the next decade. If they're pulling in the 2050 paper, that tells you something about their confidence in generating free cash flow to retire long dated obligations rather than rolling them.
Or it tells you they think rates are going to stay elevated longer than the market expects, and they'd rather retire that paper now than carry it at above market coupons.
That's actually the more cynical interpretation, and I think it's partially right. Some of those notes were issued in a much lower rate environment, 2.4% coupons. In the current environment, retiring those notes is less about reducing debt burden and more about cleaning up the capital structure for future issuance at potentially more favorable terms.
But here's where I push back a little. 4.15 billion is an enormous cash deployment for a company that just reported an earnings miss. Where is that cash coming from, and what's the opportunity cost?
That's the tension, and I don't think it's fully resolved. The optimistic framing is that this reflects a management team with high conviction that the operating challenges are transitory. They're using current cash generation to delever because they believe the core business comes back. The pessimistic framing is that this is a defensive move to reduce financial risk during a period of operational stress.
And then the third filing, the Form 4 on June 26th for Vishal Talwar, EVP and President of FedEx Digital World.
Which on its own would be completely unremarkable. 4,734 RSUs granted, 3,567 stock options at an exercise price of $319. Standard executive compensation. But in the context of this week's filings, it's actually a meaningful data point.
Because you're granting long-dated equity compensation at this price level 2 days after an earnings miss and 1 day after announcing a $4 billion debt tender offer.
Exactly. You don't do that if you think the stock is structurally broken. Those options only have value if the stock trades above $319. Management is putting its compensation on the line at current prices. That's a form of insider alignment that's easy to overlook in a standard Form 4 read.
So, taken together, the three filings this week build a case that FedEx's management is betting on the turnaround. Earnings misacknowledged, balance sheet restructuring underway, equity compensation aligned to recovery. That's a coherent internal narrative, even if the market hasn't bought it yet.
Right, and the 3% stock decline this week suggests the market is taking a wait-and-see stance. They're not rewarding the balance sheet action yet because the earnings miss is still fresh. That gap between management conviction and market skepticism is exactly where investors need to make a judgment call.
Okay, let's shift over to the EV names, because the double-digit losses for both Joby and Archer this week deserve a real examination rather than just calling it speculative froth.
Joby down 10.5%, Archer down 10 1/3. In a week where the broader aviation sector was green, majors up double digits, defense primes up 2 to 3%, even MRO names positive, those losses stand out sharply.
My initial read is straightforward. When fuel costs are the dominant macro narrative and capital is rotating into proven cash flow generators with balance sheet depth, pre-revenue technology plays get sold. It's a defensive rotation story.
I think that's part of it, but I don't think it's the whole picture. These names have been volatile all year, and the 10% move in a single week suggests something more specific than just sector rotation.
What's your read then?
The certification timeline risk is becoming harder to ignore. The FAA's type certificate process for both Joby and Archer has been, let's call it, non-linear. Every month that passes without a certification milestone is a month of cash burn with no revenue offset. And in an environment where the risk-free rate is still elevated, investors are discounting those future cash flows more aggressively.
That's a fair point, but I'd argue the certification argument has been known for a long time. The market's been pricing in extended timelines for 2 years. Why does it hit harder now?
Because the competitive landscape just got more complicated. When you have traditional aviation businesses reporting strong demand, 14 million TSA passengers this week, year over year growth intact, the urgency argument for eVTOL gets softer. The pitch is easier to make in an environment where air travel is constrained. When traditional aviation is humming, the disruption narrative is harder to sell.
And there's an infrastructure piece here that doesn't get enough attention. Even if Joby and Archer achieve certification, the vertiport infrastructure, the air traffic management integration, the regulatory framework for commercial operations, none of that is ready at scale. The aircraft being certified doesn't solve the ecosystem problem.
Which is why the institutional money that went into these names in 2024 and 2025 is getting impatient. You can only run the "we're close to certification" story for so many quarters before sophisticated investors start discounting it more heavily.
So is this a dead cat scenario for eVTOL broadly, or is it a buying opportunity for the names that survive the shakeout?
I think it depends entirely on which side of the certification finish line you're on 18 months from now. If either Joby or Archer achieves FAA type certification in 2026, which is still in the range of possible outcomes, the re-rating would be dramatic and fast. But the risk is that the cash runway doesn't extend to that milestone, and that's a binary outcome for equity holders.
So the 10% move this week is the market recalibrating the probability of hitting that milestone before running out of runway.
That's exactly it. And in a week where the rest of the sector was broadly positive, there's no covering argument. The losses are clean. The message from investors is, show us the certificate, not the roadmap.
Which makes it a fascinating contrast to everything else we've talked about today, where the market is rewarding companies that have already proven they can survive in difficult conditions and punishing everything that's still operating on the promise of future validation.
That's really the through line for the whole week. Scale, proven cash generation, balance sheet depth, those are the traits being bid up right now. And anything that requires investors to underwrite future optionality is being marked down aggressively. So let's talk about the divergence that's been sitting underneath everything we've discussed today. Because I think it's the most important structural question the week's data raises. You've got major airlines up double digits, defense primes up 2 to 3%, engine makers and aftermarket suppliers positive. And then you've got eVTOL down 10%, some of the aerostructures names down 4%, Boeing flat to negative despite genuinely good news. Is this cyclical positioning or structural differentiation?
I keep coming back to that question because the answer changes everything about how you build a position right now. The cyclical case says capital is rotating defensively into proven cash generators during a fuel shock, and when the macro stabilizes, the growth names come back. The structural case says the market is permanently repricing the winner's circle in aviation, and some of these names outside that circle never come back to where they were.
The data point that pushes me towards structural is the GD Form 4 we saw this week. Malcolm Mark exercises and immediately sells all 5,480 shares, roughly $2 million in gross proceeds. Yes, it's a routine exercise and sell, but the guy retains 10,643 shares in direct beneficial ownership. He's not abandoning the stock. He's managing tax exposure on concentrated gains. That tells you the defense prime story still has institutional confidence at the director level.
Contrast that with the AAL Form 4. David Seymour, the COO, selling 125,000 shares over 2 days under a 10b5-1 plan. Yes, it's pre-planned. Yes, it's Rule 10b5-1 protected. But that's still a significant disposition event at a $15 to $17 price point for a stock that was in single digits not that long ago. He's locking in gains.
And that's actually constructive for the bullish case on American. If you've got insiders selling at $17 under a pre-established plan, it means they set that plan when the stock was lower, which means the exercise price assumptions were probably sub 15. They're not running from the stock, they're taking profits on a recovery trade.
Right. So the insider data this week actually reinforces the divergence thesis rather than complicating it. Defense primes, orderly management of long term holdings. Airlines, profit taking on a recovery. Neither is a distress signal.
The name that breaks the pattern cleanly is GE Aerospace. Judson Althoff gets 517 RSUs as standard director comp under the 2022 long-term incentive plan, vesting on the earlier of the first anniversary or the next annual meeting. That's textbook retention-aligned compensation at a stock price that's up almost 4% this week and touching $369.
And GE is interesting because it sits at the intersection of multiple tailwinds simultaneously: commercial engine demand, defense contracts, aftermarket growth. The RSU grant at these levels is the board saying, "We think this is a fair entry price for long-term alignment."
Which brings me back to the structural versus cyclical question. The names where insiders are receiving and holding equity compensation, GE, GD, versus the names where insiders are selling under pre-established plans, AAL. The market is pricing those differently, and I think correctly so.
The cargo divergence is the one I can't fully resolve. FedEx down 3%, UPS up less than 1. Same freight environment, same fuel cost headwinds. The FedEx earnings miss, and the subsequent $4 billion tender offer should be read as management confidence. But the market hasn't given them credit for it yet.
And I think that's actually the cleanest example of cyclical versus structural playing out in real time. If the tender offer works, if FedEx successfully retires the paper, cleans up the liability profile, and executes the operational turnaround, then this week's discount is entirely cyclical and it reverses. If the operational challenges persist and the cash deployment turns out to be ill-timed, then the divergence from UPS becomes structural and it widens.
So the base case is that the major carrier re-rating and the defense prime stability reflect durable structural advantages being permanently repriced. But the key risk is that a fuel price reversal closes the competitive gap faster than the market expects, and the spread between winners and laggards compresses sharply.
That's exactly the framework I'd take into next week. And speaking of next week, let's talk about what to watch, because there are 4 specific items that are going to either confirm or break the narratives we've been building today.
Let's run them.
Watch FedEx early tender participation rates when the July 9th deadline approaches, because it will confirm or contradict whether institutional bondholders believe the operational turnaround is credible enough to tender at current prices rather than hold to maturity.
Watch any airline revenue guidance updates or pre-announcements from the major carrier group in the lead up to Farnborough, because it will confirm or contradict whether the double-digit stock gains this week are pricing in forward earnings that management is actually prepared to sanction.
Watch FAA certification activity on Joby or Archer, specifically any public docket updates or type certificate progress disclosures, because it will confirm or contradict whether the 10% drawdown this week was a rational recalibration of timeline risk or an overreaction that creates a re-entry point.
And watch Boeing's production line commentary and any Farnborough order flow previews, because it will confirm or contradict whether the NGAD win and the 4th commercial production line announcement are translating into the kind of backlog confidence that finally closes the gap between Boeing's fundamental story and its stock price, which is still down on the week despite genuinely positive news.
That 4th one is the one I'll be watching most closely, because Boeing is the unresolved thread in everything we've talked about today. The stock should be higher given the week's news flow. The fact that it isn't tells you there's still a significant sentiment overhang that good headlines alone won't clear.
It's going to take execution. Deliveries, certification milestones, clean quarters. The market needs to see the story repeated, not just announced.
And that's actually a perfect bridge to closing this out, because the theme of this entire week has been exactly that. The market rewarding demonstrated execution and penalizing everything that still requires proof of concept.
So let's synthesize. What's the one-sentence version of this week in aviation?
This week, the aviation sector stress-tested the difference between businesses with structural advantages and businesses still seeking them, and the market priced that gap with unusual clarity and speed.
I'd add one layer. The macro context, IATA cutting profit forecasts in half, fuel at 31% of operating costs, multiple carrier failures, didn't destroy the sector. It clarified it.
Which is actually the most useful framing for investors sitting with exposure right now. The question isn't whether aviation is healthy, it isn't in aggregate. The question is whether the specific businesses you own are on the right side of the clarification event.
And the data we've walked through today, from the TSA passenger numbers showing demand still intact, to the FedEx capital structure maneuvers, to the eVTOL drawdowns, to the major carrier re-rating, all of it points in the same direction. Scale, balance sheet depth, and pricing power are the traits being bid up. Everything else is being marked to a more skeptical discount rate.
So, the synthesis for this week. Demand held firm at 14 million passengers, screened with year-over-year growth intact. Capital rotated decisively into proven survivors as the cost environment eliminated weaker competitors, and the insider activity confirmed that institutional confidence at the director and executive level remains anchored in the names showing the strongest price action. That's Aviation Intelligence Weekly for the week of June 21st. I'm Sarah.
I'm Mike. We'll see you next week.
The information discussed on Aviation Intelligence Weekly is for informational and educational purposes only and does not constitute investment advice. Stock performance data, SEC filing summaries, and macroeconomic commentary are presented as analysis only. Always consult a qualified financial professional before making investment decisions. Past performance is not indicative of future results. Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Want the inside track on aviation's biggest players? Aviation Intelligence Weekly brings you expert analysis of airline earnings, breaking industry news, and deep dive company histories. From American Airlines to Boeing, we cover the business of flight every week. Subscribe now on Apple Podcasts, Spotify, or wherever you listen.